Alrighty. Hello, everybody. Good afternoon. I'm going to just hang out for a second here as people continue to join. But thank you so much for taking the time out of your lunch hour to join us today for the buying and remodeling your fixer upper with HomeStreet Bank. We have the wonderful Ryan Cooney here, one of the loan officers at HomeStreet, to just share all the information about buying or fixing, or finding a fixer upper, or remodeling one rather. And before we get started, I just want to let everybody know that this session is going to be recorded. And if you have any questions, please feel free to use the chat or the Q&A function to ask your questions. But yes, without further ado, Ryan, please take it away.
Just to reiterate, this is welcome to today's financial fitness webinar. And again, thank you for taking time out of your lunch to join us for today's topic, which is buying and remodeling a fixer upper, specifically on fixer uppers and distressed properties. So what we're going to be talking about today is defining what a fixer upper is versus a distressed property. Talking about buying a fixer upper, buying a distressed property, what a foreclosure, short sale, REO is, as well as some financing options, some tips for your renovation project. And we, as always, will finish up with the Affinity Benefits Program components. And so we'll go ahead and get started here. So defining what a fixer-upper is versus a distressed property. A fixer-upper is a house that usually can be lived in, but in need of some major maintenance work. This would be addressing things like water damage, electrical issues, replacing old appliances, and generally remodeling. In a fixer-upper home, you're generally also buying from the seller of the property. That seems a little bit redundant, but you're buying from a person, and as opposed to a distressed property, where you're going to be generally buying from either a lender or someone who has repossessed the property. And in that distressed property, you're going to see some significant repairs. The property may or may not be able to be habitable while you're doing the rehab on the property. There might be some issues with plumbing, roofing, and in general, you're going to see more health and safety hazards present in distressed properties. Okay, and then those are often also vacant or abandoned properties. So in those distressed properties, they are abandoned usually because they're the result of a short sale, foreclosure, or in the process of foreclosure. They could be already bank owned or known as real estate owned. They may have some unpaid property tax liens, but in general, they're all going to need repairs and updating and renovations. Sorry. Okay, let's start with buying a fixer-upper. The reasons to buy a fixer-upper: some people like the challenge that goes into the work. They like to do those repairs. And in general, they like to see the transformation take place from when they bought the property to what it's going to look like as its final product, especially if that's a historical home, like restoring a unique or historical home to its original condition. Really, the main reason that you're looking at a fixer-upper is going to be the price point. So these are often houses that are going under a market value for that typical property, whether that's the neighborhood or characteristics of that property. So what you're looking for is a house that might be, you're looking to get into a neighborhood that you may not be able to get into. You may have a view that you may not be able to get into. You may have just budgetary restrictions that you can't buy a property in that type of condition in a normal way, or a more traditional way rather. Okay, given that fixer uppers can be good, perfect starter homes for someone who's willing to put in the hours and elbow grease to get it into good shape. Additionally, if you're in a seller's market, you're buying a house that's, say, turnkey, they generally don't stay on the market very long, and bidding wars are common. You might not have the resources, or you might be overpaying for something that's ready to move in. Okay, regardless of their condition, fixer-uppers can be appealing to many home buyers. Again, price point is going to be the biggest benefit of buying a fixer-upper home. So, for example, if you're looking at 3 bedroom, 2 bathroom houses, what is the market price for a house that is in great condition? So, what's that price point? Is that price point, say, $700,000 for a 3 bedroom, 2 bathroom? And then what you'd be looking for is a fixer upper that might be for sale for, anywhere between 3 and $600,000. So you're buying that under that market value. You have to then put in the work to bring it up. And once you're done, completed the work, you have that final product, and you have the earned equity from doing all the work yourself while getting in at the lower price point. Okay. You also have the freedom to decide on what improvements. So you really get to make the house your own. You get to decide which projects are most important to you and what takes priority. You're going to be calling the shots, so you have the freedom to choose your own materials, the design of the house, and you get to work on your own schedule. So this final result is that you're going to greatly increase the value of the home with your quality renovations. Now, the downside of buying a fixer-upper. Before I get too far, also, Sebastian, if you see any questions come up in the chat, just go ahead and jump in at any point, and please feel free to ask any questions at any time during this process. And so if you just put them in the chat, and Sebastian can cut in with any questions also.
Sounds good. Thanks, Ryan.
Yeah. And so back to the drawbacks and downsides of buying a fixer-upper, is that it can be a trap. And what I mean by that is it takes time, resources, ability, and patience when you buy a fixer-upper home. So do you have the time to put in the work that is needed to rehab the property? Do you have the resources available to pay for the materials and the labor on a fixer-upper property? And if you are trying to do this yourself, do you have the ability? Do you have the skill set to do the renovations that are needed on the property? Are you getting into something that's going to be over your head? For me personally, I don't like to touch anything that is plumbing or electrical related, but I'm willing to try most other things in home improvement. But so just know your limitations when you're getting into a project like something that needs significant work, like a fixer-upper home. And then the last part of that would be patience. So do you have the patience to manage all of those things throughout the process as your time, resources, and ability are being stretched to the limits? A very important aspect of looking at homes that are fixer-uppers is to get a good real estate agent. And what I mean by that is you're going to want someone who is a full-time realtor. So when you're going through your process of interviewing realtors, are they a full-time realtor, or are they doing this as a side job or secondary job? Because you're going to want someone who's a full-time agent when you're looking at making an investment in something that's going to take significant work to get to bring the house into a livable condition. Okay. Also, do they have experience working on transactions where the property does need work? Oftentimes, real estate agents own multiple properties. So find out maybe if they've flipped any properties themselves prior to become a real estate agent. Do they have any um, experience working as a contractor? A lot of them do. So it's really important that you find an agent who's going to understand what goes into the rehab process of a home. They can spot some things early for you and help you make a good decision on what the work is going to be, all the work that's going to be required for that home. Okay, well, let's get a little bit into buying a distressed property. Okay, distressed property is going to refer to properties that are on the brink of foreclosure or have already been repossessed by a bank or mortgage lender. Real estate investors often seek out these properties as they're an opportunity to buy at that low price point with the high upside. Primary types are going to be foreclosures. So this would be a legal process where the lender or loan servicer takes possession of the property, and then they would sell that property to at a foreclosure sale. If that property does not sell at a foreclosure, it becomes real estate owned. So that means it's owned by either the bank or by Fannie Mae, Freddie Mac, FHA, VA, USDA. Those are all people. Those are all the mortgage-backed securities that would, once they repossess the home, they're then in charge of reselling those properties. And they're looking to get those properties off of their books, and they're likely taking them at a likely willing to take a discount in order to sell those properties and move them into another person's possession. And then short sales, and again, these are all ways that you can find distressed properties. So these are going to be homeowners who are underwater on the amount of in that they don't have any equity in the property, so they're likely not going to be able to pay off all of their loans or taxes. So they would have to get approval from the lender to sell the property with for less than what they owe on their current loan. And reasons to consider a distressed property. Again, we're talking about getting a deal. So these are, you're paying less than what a turnkey would be, with the basic principle of sound investing, that you're buying an asset for a lower price than you're going to sell it for. Okay. Also, it has the potential for home improvements. If the seller is in distress, they might not have had any recent upgrades to the property, or they may not have had the ability to make any upgrades to the property. Okay, downside of buying a distressed property. So when you're buying a distressed property, it is because someone is likely falling behind on their mortgage, which means that they may not have been doing all of the repairs. Maybe they're in distress because the property was having some serious issues. So the property is sold as is, meaning you buy the property and you take it. You're not allowed to ask for any sort of repairs prior to close. It's just you get what you get when you buy the house. And whereas a traditional sale, you might be able to renegotiate the sales price, or you may be able to get some credits for closing costs based on the condition of the property. In this case, as is means it's sold as is. Next up is title issues. So if you have a property in distress on a sale of property, when you buy the property, you have to have a clear title. So that means all mortgages are paid off, all tax liens, anyone else who claims ownership of the property, all that is settled in when you're buying a property. On a distressed property, there might be some tax liens that become part of the contract of the sale of the property. So you might be buying someone else's debt in addition to buying the property in order to make sure that you have a clear title when you purchase the home. So you're just going to want to make sure that that's something that might come up, and make sure that you are aware going into the purchase sale that you might be doing that. Okay, also closing might be longer than you expect. Traditional sale is between 21 and 30 days from when you enter the contract to when you take possession of the property. With a distressed property, you might be dealing with some legal issues with the previous owner, between the previous owner and the lender, whoever has the lien on the property. So those things might take some time to be settled. So don't be surprised if you're looking at a short sale that might take between anywhere from a couple months, even up to 6 months, and even a year before you close on a short sale. Okay, given the complexity and risks associated with short sales, we don't recommend that you go it alone unless you have plenty of prior experience doing so. Going back to where we talked about the characteristics of the realtor involved in this, make sure that you find an agent who specializes in distressed properties. They're going to bring up all of those issues that I brought up in the previous slide about what to expect for timing, what to expect they might ask the right questions on previous tax liens or other liens that are associated with the property. Make sure that you're getting into something that make sure that you know what you're getting into when you're looking to purchase that home. Okay. So again, the agent's going to check title. learn whether a foreclosure notice has been filed, determine how much is owed to the lender. All this is going to give you an edge in preparing to make a competitive offer, and overcome any roadblocks to a successful closing. Just a couple websites here to find some distressed homes: realtytrack.com and HUD Homes USA. And I'll go on to the next page where we have a couple more: homesteps.com and foreclosure.com. Some of these are free. Some of these do come with a monthly fee involved. And I'll get a series of links together to get out to Sebastian that he can send to everyone after this presentation is over. Okay, let's get into defining foreclosure, short sale, and REO. So foreclosure is the act of the lender seizing the home after the borrower fails to make payments. This is a legal process. So this is an involuntary uh, process where the homeowner has to give the property back to the lender or whoever is servicing the loan. So unlike a short sale, these are all initiated by the lenders. Where again, you're having less, the property is now less worth less than what is remaining on the loan by the current home buyer. So it's up to the mortgage lender to approve the short sale. So they have to approve a price so they're going to be losing money, and they approve how much they're going to be losing money by completing the sale. That's why there's a back and forth, and that's why it can take between 6 months to a year, because you're going through approvals from the seller, you're going through approvals from the lender, the current lender on the property, and that's why that takes so much time. But that is beneficial to the seller of the property to complete the short sale rather than the foreclosure, just because of some credit issues and timing that it creates. A short sale is going to be more beneficial in the long term for a seller than a foreclosure. And then REO is real estate owned. It's when a foreclosure occurs, a sale is unsuccessful, as in no one buys it from a foreclosure auction. The bank becomes the owner of the property, or lender becomes the owner of the property, and they would then sell the property as is. Okay, let's talk a little bit about some financing options. Um, so no matter what type of loan option you choose to purchase the home, make sure you get pre-qualified ahead of time. So this is, again, just a good rule of thumb. Anytime you're trying to buy a property, is show the seller that you've gone through the financing hurdles and that you're making a serious offer. One option for a distressed or a fixer-upper loan would be, or property would be, an FHA 203K loan. This is offered by the federal government and is designed to wrap all in one, purchasing the home and the work involved in rehabbing the home. This is a good option if you're planning to renovate your fixer-upper distressed property. If you do it this way, though, the lender will babysit you throughout the process. That means they're going to be approving permits, plans, and even the contractors that you're using have to be approved through the process. You're going to have to follow their timelines on everything. They're going to be in charge of dispersing the funds to the contractor and making sure that everything gets done in accordance that way. So this is a good option if you don't have additional funds to work on. If you can buy the property, but you don't have any funds for the fixer upper piece, that's when you look at an FHA 203K loan. And then if you have resources to do the work on your own outside of purchasing the house, then you're looking at something more like a Fannie Mae Home Ready, which is for low to moderate income. You can do as low as a 3% down payment, and you can use Fannie Mae's Home Path program, where it sells homes that are acquired through foreclosure. So Home Path is one of those websites that collects all of the homes that are for sale that have been that are REO, or real estate owned. Okay, and then of course there's always conventional financing. If you're lucky enough, though, to find a home that is free of health and safety hazards. So if you're going to do conventional financing or the Fannie Mae Home Ready, the house has to be move-in ready. to the extent that there's no health or safety hazards. So this is generally closed up walls. Um, there's no loose wiring anywhere. Windows are in good shape. Roof is in okay shape, as in it's not doesn't look like it's going to start collapsing soon. So for any details and additional home financing options, please reach out to me. I'd be happy to talk through any specifics with you. Okay, let's talk about some tips for your renovation project. Hey, you're going to want to get a home inspection. So regardless if um, you have the ability to use the inspection to request any changes from the seller prior to closing, it's a good idea to get a home inspection to give you an idea of what is all involved in the renovation project. What you're looking to avoid is unplanned or surprise costs that may arise. So if you are buying that home for $200,000 under market value, um, you're factoring in all of those costs to what your final um, value is going to be. If you have a whole bunch of unplanned or surprise costs, that's going to eat into that, and it is a risk that's included when you're buying a fixer-upper or distressed property. Okay, the home inspection is also going to help you determine what to focus on. So, are you looking to just add another story to your home or convert a spare closet into an extra bedroom? And this is going to help you start and focus on what needs to be addressed first. What are the biggest priority items? And then also down the line, what needs to be done. So it's a want versus need. It helps you build your wants versus needs list and start the plan for remodeling the property. Okay, make sure that you're getting cost estimates and research. Get a realistic estimate of how much things are going to cost to help you determine whether the project is possible at this time. Can help you determine how much of the project will be do it yourself versus professional. Remember, there's doing things right the first time is going to be more valuable than having to do it yourself and then having to repay for someone else to do the project who has a different skill set than you to make it a completed in a work-like manner. Okay. Research your local permit guidelines in your city and county. Find out how much time it will take to get what you need. There is a big cost and time difference depending on what city the property's in. I know that Seattle has a rather expensive permit process, and it also has a long timeline on permits. So you're going to need to make sure that you factor that in when you're looking to start any kind of major project on remodeling and um, especially if you're buying the home that you need to get that work done right away. Okay, work up a budget. Make sure that you add 30% for unexpected costs and materials. Make sure that that's staying within what you can afford, and make sure that you can complete the project so that you don't fall behind on the loan as well. Okay. Okay, how to start your renovation project. You're going to want to make sure that you get a good contractor. Don't just pick the first name that shows up on Google. A good idea is to check with friends and family who have gone through a renovation process, see if they have a good referral to you. Make sure you're interviewing potential candidates, and please, please, please make sure that you're getting a contractor who is licensed, bonded, and insured. What does that all mean? License means they've taken the steps and proved that they have met the requirements to complete the work that they're charging you for. Bonded means that they pay into a program that helps you recoup losses for work that's not completed in a work-like manner. And then insured is you have legal recourse for financial recovery if their work is done incorrectly and causes future problems or future damage to the house, or if they have an employee working on your property who gets hurt, they have the insurance to cover that. Because if they do not have the insurance to cover that, you are the homeowner, then you become liable. So make sure that your contractor is licensed, bonded, and insured before letting them start work on your property. Okay, there's a reason why someone who's not licensed, bonded, and insured might be able to undercut those people because all of those things do cost money for the contractor. That is built into their estimates for work for you. Okay, work up a timeline, be realistic. Your contractor, when you're talking to a contractor, they're going to give you a realistic timeline on how long those improvements are going to take. And keep in mind things like kitchen, bathrooms. Are you going to be able to live in the property during this process? Are you going to be without a kitchen for a certain time period? Is that something that you can work around? Do you need to work out other accommodations for staying in, say, a hotel or with friends or family during a certain process in there. So just make sure that you're running out all of those details with the contractor. And of course, be patient, as sometimes the best laid plans do go awry. Just keep in mind if you're going into any sort of lengthy construction process, if you go into it thinking it's likely going to cost me more money than I'm expecting, it's likely going to also take a little bit more time than I was expecting. You're less likely to be frustrated and disappointed in the process. So just be patient and go into it with those things in mind. Okay. And we'll wrap up with the Affinity Benefits Program components. And start with cost savings. We are able to provide you benefits in the form of closing cost credits if you're looking to purchase or refinance your home or second home. We also have some realtors who provide benefits as well. They can provide up to 1% of the purchase price in addition to the closing cost credits that HomeStreet can give you. We do have exclusive workplace checking, and we do have discounts on new vehicle loans and personal loans in the form of interest rate discounts. Okay. If you are looking for down payment assistance or you know anyone who's looking for down payment assistance, we are able to help you navigate the various down payment assistance programs that are available in your area. Be sure to always keep a lookout for future financial seminars, including budgeting, credit, buying a home, anything you can think of. We'll try to get something out there for you. Keep in mind that these benefits are available to immediate family members. So if you have parents or children who are looking to buy a home, eligible for the same credits that you are that were mentioned at the top of the slide. So be sure to ask, and I'd be happy to walk you through the steps in making sure that your family member can get those same benefits. And as always, this is exclusive access, so you need to reach out to me here at HomeStreet. In order to get that benefit, it has to be an Affinity loan officer. So please reach out to me if you have any questions. Okay, and with that, again, my name is Ryan Cooney. I'm a loan officer here at HomeStreet. For those benefits more defined, you can go online to homestreet.com/UW. And with that, I will be here for any questions that you have.
Amazing. Thank you so much, Ryan. Uh, it's the affinity benefit is a wonderful benefit. I'm not sure if many other workplaces do offer that, but it is a great perk to have. But yes, let me see here. I also want to mention that if anybody would like to unmute to voice their questions, they are also welcome to do that now as well. But yes, if anybody has any questions, please feel free to type it out in chat. We'll hang out here for a few minutes. And but before we get too far, just thank you again, Ryan.
Yeah, of course.
Yeah. And like Ryan mentioned, I also want to say that we will be sending out the slides to today's session afterwards as well. Um,
Yep.
let's see here. Sam asked, do you have any information of the USDA direct loans?
Um, the USDA direct loans, since those are just kind of just as it's stated, they're directly through the USDA. I don't have a ton of information on that. HomeStreet does have USDA loans right now, but the USDA direct loans, you would have to go through directly through their website to find more information on that. Sorry, I don't have a better answer on that one.
All good. Thanks, Ryan. And then Karen
Yeah.
asked, do you need to have an account with HomeStreet to access the services at HomeStreet?
Are you talking about the affinity benefits that I mentioned? We do not require that you open up a checking account to get the credits when you're purchasing a home or if you're getting a car loan or personal loan.
Great question.
Mhm.
And then Sam asked, how about construction loan options?
Yeah, so there are limited new construction loan options out right now. What you're doing in that process is similar to how I described the 203K loan, in that you will be purchasing, if you don't have the raw land already, what you're doing is purchasing the land and you're also factoring in the main benefit is you're factoring in the future value of the home after the construction is completed into your minimum down payment required to start that process. But same idea where you're putting together the plans, permits, and contractors all approved um, through the lender, and they're dispersing the funds out with each step of the process.
Understood. Thanks, Ryan. Norma asked, can you use the Affinity program to purchase a second mortgage?
By second mortgage, do you mean a new home or a second loan on a current home? If you mean a second home, the program is eligible for second homes. You do not have to be a first-time home buyer to use that benefit.
Great. I think that was it.
Yeah.
Uh, more loan questions here for you, Ryan.
Good.
Yes, you said similar. Can you use a FHA 203K as a new construction loan, or is that just a separate category of a loan?
That'd
Or,
be a that'd be a slightly separate category. So a 203K generally has a financing limit on what you're allowed to expense in terms of the construction costs. Whereas a new construction loan, generally that's the majority of what you're financing is the construction costs. So it would be a separate category, yeah.